Okay, and welcome to the first of the weekly webinars from Fledge and Aviary. And today's is called You Were Doing It Wrong, Investing in Startups Without Waiting for an Exit. My name is Looney Libis. I am a serial entrepreneur. I have spent 25 years of my life starting companies. First 20 years I spent in tech, doing 5 software startups. All but the first were venture-backed. And so I'm well aware of the venture capital model. I have sat on both sides of the table now. And then I had a big transformation in my life in 2011 when I started mentoring at a business school called Pinchot University. And that is the first business school in the world to teach a sustainable MBA, or how to do good and do business at the same time. I'm now a faculty member there. And through learning in that environment, I then left the tech world and started in the social good world. And founded a business accelerator called Fledge, which I'll talk about later. And then this year, started a seed capital fund called Aviary. All right, you guys are here to hear about financing startups. So this is the general graph of growth and stages of maturity in startups. What happens in here is generally an idea gets formed, it gets funded by friends and family. We'll call that the pre-seed stage. These stages don't have exactly pure names that everyone agrees upon. Then companies hit upon the valley of death, where they have a hard time finding money from angels and angel groups. And then they figure out how to find customers. They find out what customers actually want. They get in a phase where professional capitalists do eventually show up, and that's the growth stage. And then finally, at the end of life of a startup, the company either matures and is a standalone company, which is rare, or gets acquired, which is the more common path these days, or goes public. So in this case, we're talking mostly about filling up the gap in the valley of death. It is a gap that exists in most industries, both tech and non-tech. All right, the key here is that the growth of the startup in terms of value, or you can just think of that as revenues, is at least 10x between the seed stage and the exit stage. And so if you're in the traditional early stage startup investment model, if you're sitting in an angel group these days, they're going to teach you that you need to make a 10x return on all your investments. And what they don't tell you is why. They don't explain where this 10x comes from. Well, it comes from this particular model here. So in a typical angel or venture capital portfolio, for each 10 investments made, you should expect one successful company. So one company that actually makes that 10x return. You should expect 2 that do well. And doing well is, 3x, 5x, 7x, something like that. 3 of the companies will return capital to you, return exactly what you put in. That will take 3 or 4 years. So in fact, that's a loss because you have lost the chance to make any more money on on those investments. And the reason there's so many singles is because the paperwork, the structure of the investment for angel investments and venture capital investments includes a provision for returning capital. And then 4 of them will die and return nothing. Or they'll be zombies and they'll return nothing. But 4 out of 10 will return nothing. And so when you take the weighted average of these 10 investments, you'll get 2.3, 2.5, maybe 2.6 times cash on cash return. That is the actual expected return of a successful portfolio from angels or VCs. And there is plenty of research. There's plenty of actual data of actual portfolios to say that it is possible to get 2.5 times your money back in 7 years. Okay? So that's the basis of the 10x. If you don't get that 1 out of 10 10x's, then you don't do well in your portfolio. And the reality is that most of the investments, as you just saw there, so 9 out of 10 of the investments are not going to return a 10x. The actual goal, right? The goal is not to do the 10x. The goal is for the portfolio to return at least 15% IRR, they call it. If you're not familiar with that term, it's internal rate of return. You can think of it as the equivalent interest rate you would have to be earning in order to make the investment. So the actual goal is to return about 15%, and I say about because the true goal, the fundamental goal here, is simply to beat the S&P 500 by a half a point, by 5 points, or to beat the S&P by some multiple like 1.5. And the reason is that early stage investing is risky, right? As we saw a few slides ago, 7 out of 10 of those investments are not going to beat the S&P. 7 out of 10 times you invest in the traditional investment model, you're going to lose. You should have put your money in an index fund, or you should have just put your money in a savings account for the small amount that returns. That would have been a better investment 7 out of 10 times. And I'm going to say this one more time because this is what's considered a successful investment or a successful portfolio for venture capital investors, professional investors who spend all their time every day trying to find the best deals and investing in the best deal flow. They're going to fail 7 out of 10 times. So if they do that, what chance do we have as angel investors or as seed stage investors? All right, so here's their thesis. Here's how they aim and how you've been taught to aim to beat the S&P. So first, you need to find giant market opportunities, right? Because the only chance you have to make a 10x return is if there's a 10x growth potential. So you have to find markets that are huge, ideally billion-dollar markets. 2, you need to go and grab that market as fast as possible. So you need a business plan that has fast growth, right? And 3rd, you have to have a great team, right? And you may have heard that the first thing you need to look at is team, and the second is team, and the 3rd is team, and the 4th is team, and so forth. But that's actually false. The first thing you need to look at is a giant market opportunity and a fast growth plan, and then a great team that can execute that. And the 4th one that's not listed and never spoken is that if you do this, if your great team does in fact succeed at hitting that fast growth, then some company will acquire the startup. And that is not true in most markets, but it is true in tech. And therefore, this is working in tech and has worked for about 60 years in tech for some venture capitalists and some angels. Right? A few other pieces that are hiding in this thesis are that you need to burn through a large amount of cash to do that fast growth. We can see that today in Uber. So Uber's burned through something like $15 or $20 billion worth of cash in order to be the company they are. And they're not profitable yet. They're going to continue burning through cash as long as anyone will give them money to burn through. All right. If you do this and you do this well, you can beat the S&P 500. Truth is, only about 15% of venture capitalists beat the S&P 500. So this seems a little strange. Let's take it one step further, though. So if you look at the reports from the Kaufman Foundation and the U.S. Small Business Association, you'll learn that there are over 500,000 new companies per year in the United States, right? Not startups in the sense of tech startups, but new companies. There's actually about 550,000. And so if we strip out the ones that are just holding companies and whatnot, we get to about 500,000 new companies per year. Of those 500,000 companies, only 2,000 new companies get funded by the venture capitalists per year. So they're looking at a very small sliver of all the companies there are. So that's less than 1%. It's less than one half of 1%. It's 0.4% of all those new companies per year get venture capital funding. They get 99% of all the news, but only 0.4% get funded by venture capitalists. Last year, last year, 2015 numbers, there were only 275 exits. So that's IPOs and acquisitions. So of all the companies that got started 5, 6, 7 years ago, and it's steady at about 500,000 a year, less than 0.5% actually exited. And so from that, you can see, again, another view of the 1 in 10 model succeeds. And so here's what we're looking at. So 99% of all the new companies, all the startups, are considered uninvestable by the venture capital model. And the angels follow the same model, but I'm going to call it the venture capital model. And 86% of all the companies that they invest in don't succeed, don't make it to an exit. So this seems rather odd. This seems like a good position in time to sit back and say, is this a good business model? Is this the model that I should be following as an angel investor or a seed investor in order to invest if I am expecting a 14% success rate looking at less than 1% of all the startups there are? The question is there some other way to do this? So if that doesn't work, if that model is broken, how can we invest in startups, or how should we invest in startups? And so let me show you another way. All right, one last piece though. We're told in business school and we're told in life that there are only two forms of investment, that there is debt and there's equity. And I've just shown how the preferred equity model used by venture capitalists doesn't work. And the debt model doesn't work either. And so let me just explain just make sure everyone understands debt and equity and why they don't work. So here's a quick model. In the debt model, so what we have here is the gray line is the company revenues, and we're just assuming a nicely growing company. Little green bar is the money you're handing over to the company. And the orange is the money they're handing back to you as an investor. So in this case, you hand them over some money, and they promise to pay you, if it's debt, a fixed amount of money per quarter, per month, per year, whatever your time frame is, for a certain amount of time, and then it ends. Now the problem with this is that you need to make 15%. Right? So that's problem A, is that you need to earn 15%, which means you need to charge at least 15%. Some of them are going to pay you back, so you need to charge more than that. But the real big problem here on the company side is that they can't afford the first few payments because they haven't grown their revenues yet. And when you add up all of the money that they're paying you back, it's not going to get to 15% because that's a pretty high interest rate. And in fact, given that 7 out of 10 companies are going to either fail or do poorly, you would have to charge something like, 10 times your money back, right, in order to make the same amount, or maybe a little bit less. So you'd have to charge about 500% interest, which would then make every payment unaffordable to the company. So that doesn't really work. The equity model is even simpler. The equity model is you give money to the company, and then sometime later, way later, in research it shows that it's about 6.5 years on average, you get paid back more. In the research it's shown that the zeros come in a year and the ones come in 2 or 3 years, but the winners come in about 6.5, 7 years, and they pay you back more. And so that's the dotted line way out in the distance. And the problem here, again, is that you need to have a 10x return in order to make this work. And as we saw, that doesn't come very often, right? Second problem, of course, is you have to wait 6.5, 7, 8, 9, 10 years for that return. And in the meantime, you're just waiting. There's not much for you to do except put more money into the company. All right, so let's talk about something that's neither debt nor equity, but what we're just going to call revenue-based investing. So in this model, you again hand over capital to the company, and they are going to pay you back a small amount at a fixed period of time. It's usually quarters, sometimes it's years. And the key is that you are setting a percent of revenue that they are sharing with you up to a fixed total return. So let me spell this out a little more clearly. So again, we're going to compare debt and equity. So if we're doing a $100,000 investment in debt at 15% interest, let's say it's 3 years, they're going to pay you back $132,000, and you will earn a 15% IRR because you set 15% interest. That's more or less what the term means. Versus if you gave the company $100,000 and they returned $1 million to you 7 years later, you actually got a 10x return. That would also be a 15% IRR. In the revenue case, if you hand over $100,000 to a company, you would decide ahead of time to set 3, 4, 5, 6, maybe 9% of top line revenue, some single digit percentage of top line revenues, you would get back, let's say $300,000. So that'd be a 3x return. They'd be paying you whatever that percentage was, quarterly or annually. And you would set the percentage of revenue and the multiple of return to get 15%. You could compute that ahead of time, and you could aim for that, and you could aim a little high, given that revenues generally show up a little slower than expected. But you can get the same return that you can get in debt and you can get in equity without overburdening the company with debt payments and without waiting 7 years for equity. All right, this can be structured as either a loan or as equity. So if it were a loan, for instance, you could do the $100,000 investment, and the items that are underscored are really the variables. So in this case, you're saying we'll pay you 5% of future quarterly revenues at a 2x multiple, and you could sit on a spreadsheet and figure out what that would be in terms of IRR. The way Fledge does this is as equity. So we make $20,000 investments in companies, and $20,000. We're a business accelerator, and so $20,000 is the normal amount for business accelerators, as is 6% ownership. So we buy 6% of the company, and the company promises to buy back half of those shares for $80,000. And they do that using 4% of their quarterly revenues. So each quarter, they calculate what their revenues are. They multiply that by 4%. They then divide by the number of by the share price that we've agreed upon. That gets us $80,000 for half of the company. And that gives us a 4x return. It takes 4, 5, 6, 7 years, depending on the company. We're investing exceedingly early in the case of Fledge. And we're aiming to make about 15% IRR on that. There's been a few others in town in Seattle that have done models like this as well. So Community Source Capital, they sold about $500,000 worth of shares at 50 cents a share. And in their stock purchase agreement, they promised to repurchase 2/3 of their shares at $1.50 a share. So you can calculate that looks like 3x, but they're only buying back 2/3 of the company. So you are being exited from this company as an investor for 2 times what you paid them. And then you still own 1/3 of the company after that, right? And they did that with 5% of quarterly revenues. Similarly, there was a deal called Earth Equity Farms. This is an organic greenhouse grower down in Mexico. They raised money up here in Seattle. They did about $600,000 in their first round, or their only round. And they sold them for about 33 cents a share. I just rounded these numbers to make them easier. The actual number was some odd number. And they promised to buy back half the shares at 99 cents a share. So there's a 3x return for half the shares, which is a 1.5x return on those redeemable parts of the shares. And what was interesting about this particular deal was that the redemptions are optional. So what we were able to do in the Earth Equity Farms deal was to put revenue-based investors and equity-based investors together in the same deal, in the same paperwork, all at the same time. And those investors that don't want to participate in the redemptions don't. And those that do, do. And so we were able to mix the equity model and the revenue-based model all in the same paperwork, all at the same time. So to do one of these deals, there's really 2 key variables that you play with. You create a spreadsheet of projected revenues, and from that, you determine what single-digit percentage of revenues you want to take. You determine what the multiple is going to be, what the maximum amount of cash is paid back to the investors. And that is typically somewhere between 2x and 4x for early stage deals. And there are about a half a dozen funds in the US that do this solely for growth capital. And their norm is to do it as 2x. Other things to think about is whether or not you want to structure it as debt or equity. That is a discussion best left to the lawyers. The debt and the equity decision mostly affects the tax rates and who gets to deduct who gets the better tax rate, right? If it's debt, then the company gets to deduct the interest they're paying. If it's equity, then the investors get to pay capital gains tax. which is lower than normal income tax in the U.S. You get to decide whether, if you're doing this as equity, you get to decide whether the company is buying back all the shares or whether there's some residual equities, is what I call it. And that residual equity, I didn't describe it in those deals. It's there in case there is an exit. So when I'm an investor and I'm looking at these deals, I look at the return on investment from the redeemable part as the return, and anything else is upside. Anything that's not being purchased back in redeemable shares is there in case there happens to be a good exit, in which case we'll make a little bit more. You get to choose whether or not the redemptions are optional or mandatory. Personally, I love mandatory. And then any other preferences that are normal in an early stage deal. You want a board seat? Is there a right of first refusal? Do you have follow-on rights? All those normal rights you can tack onto these deals as well. All right, so with that, if you invest in that style, then all of a sudden you discover that of the 500,000 companies that get started each year, they're all investable. As long as they earn revenues, which all of them want to do, then there is a path to make them an investable startup, right? Investable, funny enough, it has nothing to do with the startup, and it has only to do with the investor and their style of investments. And with that, we could, in fact, fill the gap of seed funding. There's plenty of money in the US and in Canada and the rest of the developed world to seed every single startup. What we're missing is the right models to do it. All right, so quick words about Fledge and Aviary. So Fledge is the Conscious Company Accelerator. We invite great, impactful companies from around the world to Seattle for a 10-week training program. We do hand them $20,000 and invest in them as well. There's been 55 graduates spanning 16 countries. There's some really great inspirational companies. So I highly suggest, if you haven't been before, come to the Fledge website. Go click on Demo Day and enjoy hearing about these great impactful startups. And then Aviary is an impact seed fund. It has just been announced earlier this year. It has not got up and running yet. And its goal is to invest in the best graduates from Fledge, the best graduates from Techstars, the best graduates from other accelerators that are helping impactful companies get started. I'll open this up to questions in a moment, but I just also want to say that there are, this is a weekly webinar series. Next week, the topic is measuring the impact of your whole portfolio, how to add the impact of a chicken to the impact of a solar panel. And 2 weeks from today, the discussion topic is philanthropy doesn't scale, how the only solution to poverty and hunger are through for-profit means. So with that, I'm going to open this up to questions.